carnage, panic, bloodbath doesn't even begin to cut it. And you look at the declines on the region's benchmark, worst since 2008. It is across all asset classes. We're seeing the reeling from this ramped up tariff war, and it is also across geographies, across sectors when you're looking at stocks. Really interesting as well, the likes of the Singapore benchmark, normally seen as very stable, plunging by the most on record. That tells you a lot. The difference this time around for traders that are looking for a reference, is this as bad as GFC or March 2020, is that if you're comparing this to the early days of the pandemic, Powell doesn't seem like he's willing or very eager to kind of swoop in with support. And for China, that's back from an extended weekend, it just shows you how they are also part of the tariff pain, because there was speculation that the optimism of Chinese support measures would mean that the declines were not as bad today. But look at the Hang Seng, almost 11% down, the worst decline since the GFC. If you're looking at the Hang Seng Tech Gauge, is the worst on record since 2015. Flip the board. The question also becomes what China is going to do amid these tariffs. If you look at some of the moves on the renminbi in the first tariff war, depreciation of about 10%. Some strategists say this time around we could see 15% devaluation of the yuan, as much as 30%. We have the likes of Mizuho saying, no, that's not the case, that the PBOC is unlikely to want the yuan to devalue because they want to anchor growth expectations, and they also want to prevent capital outflow. So keep that in mind, even as we see the renminbi taking a hit today.